If you're over 60, there's one simple tax mistake that could quietly drain thousands of dollars from your savings overnight. No warning letter, no phone call from the IRS. Just one day you log into your account and realize the money you worked decades to build is gone. As a wealth advisor, I've seen far too many retirees stumble into this trap, and not because they were reckless or careless with money, but because of something they thought was smart, something they thought would protect them. Their retirement accounts. Yes, really. The very accounts designed to secure your golden years, IRAs, 401ks, pensions, can backfire when you make this one mistake. Every year, millions of seniors unknowingly overpay the IRS, lose benefits they could have kept, or trigger penalties that quietly pile up. And the scariest part, most of them never even realize it until it's too late. That's why today I want to walk you through 5 common tax missteps that can wipe out retirement savings, shrink Social Security checks, or push you into a higher tax bracket overnight. If you've ever withdrawn from an IRA, collected Social Security, or left money sitting in the wrong place, this video could save you thousands. Before we dive in, I'd love to know, have you ever worried you might be paying more taxes than you should? Type yes in the comments if you've had that thought, or no if you've always trusted the system. And if money security matters to you or someone you love, don't forget to like this video and subscribe, where I share honest, practical strategies to help older adults keep more of what they earn. Now let's start with the most surprising mistake of all: required minimum distributions, or RMDs. One missed step with these and the IRS can take 50% of your money overnight. You've probably heard of RMDs, those yearly withdrawals the government forces you to take from your retirement accounts once you hit your early 70s. And you might think, well, I'll just take it when they tell me. But here's what most seniors are never warned about. Missing or miscalculating your RMD by even $1 can trigger one of the harshest penalties in the entire tax code. I know that sounds dramatic, but I've seen it happen firsthand. Take Mr. Charles Whitman, for example, a 73-year-old retired engineer from Ohio. Charles was meticulous. He built bridges, for heaven's sake. He kept every receipt, every file. But one year he forgot that his old 401k from a past employer also had an RMD due separate from his IRA. He took the withdrawal from the IRA, but forgot the small balance sitting in that old 401k. He thought it didn't matter. The IRS thought otherwise. When tax season rolled around, he got a notice that shook him to his core. He owed a penalty equal to half the amount he should have withdrawn. Not 10%, not 20%, 50%. Overnight, he lost nearly $6,000 from a forgotten account worth just $12,000. Here's what most people don't realize. Once you cross age 73, the IRS doesn't care whether you need the money or not. They want their slice, and they want it on time. The deadline is December 31st each year. Miss it, even by one day, and the penalty hits hard. And it's not just about forgetting an account. Even taking the wrong amount, say you calculated based on last year's balance instead of December 31st, can trigger the same penalty. And here's the kicker. Many seniors have multiple accounts, old jobs, rollovers, spousal accounts. One slip, and the penalty applies. As we get older, it's easy to forget about that small balance sitting in an old plan. But the IRS never forgets. Charles told me, "I spent my whole life saving carefully, and in one year I lost more than I gained from interest." His voice broke when he said it. And he's not alone. I see this every tax season. People who played by the rules, yet lose thousands because no one warned them. That's why my advice is simple. If you're 73 or older, make a master list of every retirement account you own: IRAs, 401ks, pensions, annuities. Then calculate your RMD based on the latest balance, and don't wait until December. Take it early in the year, so you're not scrambling during the holidays. And if you're unsure, work with a qualified advisor to double-check your math. A 1-hour review could save you thousands. Do you know the exact age when your RMDs start? Type RMD in the comments if you do, or unsure if you'd like me to explain it in detail in a future video. And if this already opened your eyes, give this video a like to help others avoid the same mistake. Now, if you thought RMDs were harsh, wait until you see what happens when Social Security benefits, your very own retirement paycheck, suddenly become taxable. It's one of the most common traps seniors fall into, and it can shrink your monthly check faster than you think. Social Security, it's the foundation of retirement for millions of older adults. You worked for decades, paid into the system every paycheck, and finally at 62, 65, or 70, you start receiving those benefits. Most people assume that money is theirs tax-free. After all, it's already been taxed once. But here's the trap that so many seniors never see coming. Depending on your other income, up to 85% of your Social Security check can be taxed. That means the check you count on every month may quietly shrink without you even realizing why. And the mistake that triggers something as simple as withdrawing from your IRA or taking an extra dollar of income at the wrong time. Let me tell you about Mrs. Patricia Long. She was 68, a retired school teacher from Michigan. Patricia loved her garden, her grandkids, and the sense of security she felt when her Social Security checks started arriving. She assumed she'd have enough between her benefits and a small pension to cover her needs comfortably. Then one December, she decided to take out an extra $5,000 from her IRA to help pay for holiday gifts and a new roof repair. It seemed harmless. After all, it was her money. But when tax season rolled around, she got a shock. That $5,000 withdrawal pushed her into what's called the Social Security tax torpedo. Suddenly, not only was her IRA withdrawal taxed, but 85% of her Social Security benefits became taxable too. Overnight, her tax bill jumped by over. Patricia told me, "I thought I was doing the right thing, just using the money I saved. I never dreamed it would come out of my Social Security." Here's what happened. The IRS uses something called provisional income to decide how much of your Social Security is taxable. It includes your adjusted gross income, plus half your Social Security benefits, plus any tax-free interest like municipal bonds. Once your provisional income crosses certain thresholds, just $25,000 for singles and $32,000 for married couples, your benefits start getting taxed. Cross the upper limit, and 85% of your benefit is taxable. And here's the cruel part. These thresholds haven't been updated since the 19th. A small withdrawal can push you just over the threshold, creating a domino effect where every additional dollar of income pulls more Social Security into the taxable column. It feels like you're being taxed twice. In Patricia's case, her $5,000 withdrawal effectively raised her taxable income by nearly $9,000 once the formula kicked in. That's the torpedo. And she's not alone. Mr. George Davis, a 72-year-old retired truck driver I once worked with, fell into the same trap. He and his wife lived modestly in Kansas. They had Social Security and a little income from George's part-time handyman jobs. But one year, he decided to cash out a $12,000 CD to help his granddaughter with college tuition. That single move triggered taxes on their benefits for the first time. They owed nearly $3,500 they hadn't budgeted for. George said, "I've never missed a payment, never owed anyone a dime. Now I feel like the IRS just robbed my Social Security." This is why planning around Social Security is so critical. If you don't understand how the tax torpedo works, you could lose thousands of dollars every year. And here's something many don't realize. Even tax-free income from municipal bonds can push your Social Security into the taxable range. Imagine thinking you're safe because your bonds are tax-free, only to discover they're costing you benefits on the back end. The good news is, there are strategies to reduce or avoid the trap. For example, withdrawing from Roth accounts instead of traditional IRAs doesn't count toward provisional income. Spreading withdrawals across multiple years, instead of taking one big chunk, can also help. And careful timing, taking money in January instead of December, can make a huge difference in how your provisional income is calculated. Another overlooked strategy is coordinating with your spouse. If one of you is still working, delaying Social Security while drawing down retirement accounts can sometimes lower lifetime taxes dramatically. Every case is unique, but the key is awareness. Once you know the trap exists, you can take steps to avoid it. Patricia told me later, "If I had known one small withdrawal could cost me my Social Security, I never would have done it that way. I would have planned better." That's why I share her story, so you don't make the same mistake. The IRS won't send you a warning. Your financial advisor might not even bring it up. But if you're on Social Security, every withdrawal you make matters. Do you know if your Social Security is being taxed right now? Type SS in the comments if you've ever seen it on your tax return, or not sure if you're curious to check. And if this opened your eyes, hit the like button to help others avoid the same costly surprise. Now, if you thought losing part of your Social Security check was tough, wait until you see what happens when Medicare premiums suddenly jump because of a hidden tax called ARM. It's one of the most frustrating penalties I've seen seniors face, and it can add thousands to your yearly health costs without warning. In the next part, I'll show you how one retiree lost nearly $4,000 in a single year, not because she got sick, but because of one small financial move that pushed her over the line. Medicare. For many older adults, it's the safety net that makes healthcare affordable in retirement. You pay into it for decades. And finally, when you turn 65, you can breathe a little easier knowing that basic coverage is there. But here's what most seniors don't realize. There's a hidden tax called ARMA-A, the income-related monthly adjustment amount, that can quietly raise your Medicare premiums by hundreds of dollars a month. And the worst part? It doesn't come with a warning. You don't get a call from Medicare saying, hey, you're about to cross the line. One small financial move, and suddenly you're paying thousands more each year for the same exact coverage you thought was guaranteed. Let me tell you about Mrs. Linda Cooper. She's a 70-year-old retired librarian from Pennsylvania. Linda had always lived within her means. Her Social Security and a small pension covered most of her expenses. But one year, her roof needed repairs. The contractor quoted $15,000, and Linda decided to take the money out of her IRA. She thought it was a smart, responsible move. After all, that's what the savings were for. But what she didn't realize was that this one-time withdrawal pushed her income just over the ARMA-A threshold. A few months later, she got a letter in the mail. Her Medicare Part B and Part D premiums were going up. Not just by a few dollars, a total increase of $325 per month. For an entire year, that's nearly $4,000 gone, all because of one withdrawal. Linda called me in tears. I did everything right. I saved. I paid my bills. I fixed my home. How is it fair that they take away my healthcare money because I used my own savings? Here's the cruel reality. ARMA-A isn't technically a tax, it's a surcharge. A premium adjustment, based on your income from 2 years prior. That means the withdrawal Linda made in 2022 determined her premiums for It's a delayed penalty, which makes it even more confusing. Seniors often don't connect the dots. They think Medicare just went up. But in reality, their own financial choices, sometimes completely necessary ones, triggered the increase. The thresholds are surprisingly low. In 2023, if your modified adjusted gross income was above $97,000 for individuals or $104,000 for couples, you paid more. But even just $1 over that line, and you're bumped into the next bracket, and the penalties stack. There are multiple tiers, each raising premiums higher and higher. For someone living on a fixed income, the difference between paying $65 a month and paying $500 a month is devastating. And it doesn't stop at withdrawals. Selling stocks, taking capital gains, converting a traditional IRA to a Roth, even selling a rental property can all push you into higher ARMA-A brackets. I once worked with a retired couple, Mr. and Miss Alvarez, who sold a vacation cabin they'd owned for decades. They made a $60,000 gain. They thought it was a blessing. Finally, some extra money for travel and grandkids. But 2 years later, their Medicare premiums doubled. They paid nearly $6,500 more in 1 year. They told me, we thought we were free to use our money however we wanted. Now it feels like we're punished for living. That's why ARMA-A is so sneaky. It doesn't just hit the wealthy. It hits middle-class retirees, who make what feels like one small reasonable financial decision. And because the calculation is based on income 2 years back, by the time the letter arrives, it's too late to change anything. So what can you do? First, awareness is everything. Know the thresholds. If you're planning a big withdrawal, a Roth conversion, or the sale of an asset, time it wisely. Sometimes taking a withdrawal in December instead of January can mean the difference between 1 year of higher premiums and 2. Other times, spreading a large transaction over 2 tax years can keep you under the line. Second, consider strategies like qualified charitable distributions, QCD. If you're over 70 HULAF, you can give directly from your IRA to a charity, and it doesn't count toward your taxable income. That means you can meet your ARM-D requirements without pushing your income higher and triggering ARMA-A. And third, don't make decisions in isolation. Before you sell, withdraw, or convert, run the numbers or talk to someone who can. I've seen people save thousands simply by adjusting the timing of their actions. Linda told me later, if someone had just told me I would have taken half the money 1 year and half the next, I could have avoided the penalty completely. That's the heartbreaking part. Most of these costs are preventable with just a little planning. Do you know if you've ever paid the ARMA-A penalty? Type Medicare in the comments if you've seen your premiums jump, or not yet if you've been spared so far. And if this made you think twice about your next withdrawal, give this video a like to help others avoid the same trap. Now, if losing thousands to ARMA-A feels unfair, Wait until you hear what happens when seniors mismanage capital gains and property sales. I've seen people pay more in taxes on the sale of a house than they ever imagined, wiping out years of savings in one transaction. In the next part, I'll share the story of one retiree who sold her family home, only to discover the IRS was waiting with a bill that cut her profit nearly in half. And the worst part, it could have been avoided with one simple step. For many older adults, the family home is more than just four walls and a roof. It's where they raised children, hosted holidays, built decades of memory. By the time retirement rolls around, many seniors decide to downsize, sell the big house, move into something smaller, maybe a condo or senior community. It feels like a smart financial move. But here's the trap almost no one warns them about. Selling a home without understanding capital gains taxes can cost you tens of thousands of dollars in one shot. And once the sale is final, there's no undoing it. Let me tell you about Mrs. Eleanor Harris, a 75-year-old widow from California. Eleanor lived in the same house for 42 years. It was where she and her late husband raised 3 children, where she planted her rose garden, where she hoped to spend her final years. But eventually the upkeep became too much. Her kids encouraged her to sell and move closer to them. When the house finally sold, she felt both relief and pride. The market was strong, and she got nearly $900,000. She thought, perfect, now I'll have enough to live comfortably. But a few months later, a letter arrived from the IRS. It said she owed over $60,000. Eleanor was stunned. How is that possible? She asked me when we sat down. I thought selling your primary home was tax-free. Here's the truth. The IRS does allow you to exclude some profit on the sale of your primary residence, up to $250,000 if you're single, or $500,000 if you're married filing jointly. But Eleanor had lived in a hot housing market for decades. She and her husband had bought the house for $150,000 back in the... When she sold for $900,000, her gain was $700,000. And because she didn't plan ahead, that gain pushed her into a higher bracket, cost her thousands in federal and state taxes, and even raised her Medicare premiums 2 years later, because of the income spike. The saddest part is that Eleanor could have avoided much of this if she had documented improvements, like the new roof, the remodeled kitchen, the landscaping. She could have added those costs to her home's basis, reducing the taxable gain. If she had planned the timing differently, she might have coordinated the sale with other income years to minimize the hit. And if she had considered gifting part of the property to her children, or exploring a step-up in basis through estate planning, the tax burden might have been dramatically lower. But she didn't know. No one told her. Eleanor said to me, I thought I was passing on a legacy. Instead, I feel like I gave half my house to the IRS. She still made enough to move and live comfortably, but she lost money she could have used to travel, help her grandchildren, or simply enjoy her retirement. And she's not alone. I've seen seniors lose tens of thousands from home sales, rental property sales, or even selling stocks they held for decades, all because they didn't realize the capital gains rules are stacked against the uninformed. Take another case, Mr. Raymond Chen, a 68-year-old retiree, who sold a small rental property he had owned for years. He figured since it was just a little side investment, the tax wouldn't be bad. But because it wasn't his primary residence, he didn't qualify for the he owed nearly $40,000 between federal and state taxes. Worse, the gain increased his provisional income, causing his Social Security benefits to be taxed that year, and pushing his Medicare premiums higher 2 years later. One sale, 3 separate hits to his retirement income. This is why I always say, when it comes to property and investments, timing and planning are everything. Sometimes selling in stages, using a 131 exchange for rentals, or simply holding until you qualify for better exemptions, can make a huge difference. Other times, documenting every home improvement, keeping records of purchase costs, and coordinating with your advisor before listing the property can save you thousands. The IRS doesn't care that it's your family home. They see a gain, they want their share. But with awareness and planning, you can keep more of what you've built. So if you're thinking about selling a home or property in the next few years, here's what I recommend. First, gather your paperwork. Every receipt, every improvement, every cost tied to that home matters. Second, talk to a tax professional before you list, not after. Once the sale closes, your options shrink. And third, think about your bigger financial picture. A large gain doesn't just mean taxes that year. It can ripple into your Medicare premiums, Social Security taxation, and even estate planning. Eleanor's story broke my heart because it was preventable. She told me, if I had just known, I would have done things differently. I thought I was safe, and that's the common thread in every case I've shared. Whether it's RMDs, Social Security, Medicare, ARMA, or capital gains, the danger isn't recklessness, it's not knowing. Do you know what your home might sell for today, and what your gain would be after exclusion? Type home in the comments if you've thought about selling, or staying if you're holding on. And if this opened your eyes, hit the like button so others can learn before it's too late. Here's the final takeaway. In retirement, every choice matters more. The rules are complex, the penalties are harsh, and the IRS isn't going to give you a warning. But awareness is power. When you understand the traps, you can avoid them. You can keep more of your money for the things that really matter. Your health, your family, your independence. If any part of this series spoke to you, tell me in the comments what's one change you'll make starting tomorrow. And if you want more guidance on protecting your wealth in retirement, please subscribe to Wealth 365, where we'll keep learning, growing, and building financial security together. You're not alone on this journey, and it's never too late to take back control of your money.